Welcome back to JeeMoney. I'm here to help you invest in your future. Now today, we're going to talk about what to look at when you start investing. So let's get started. Now if you think about it, investments can be almost anything, right? I mean, sure, you can follow the crowd and rush out and buy a Tickle Me Elmo. Oh, what a cute Elmo. Okay. This is not a Tickle Me Elmo, but I couldn't afford a $1,000 one. Or you can rush out to buy the Chewbacca mask. Now, I never understood why she was laughing. It's not even funny. Now you can rush out to buy a bunch of them to make a quick buck, but I'll recommend a more sane way to invest. Now, all investments basically have two attributes about them. The first attribute is called a return, or some people call it a yield, or basically what the investment actually produces. And the second attribute of an investment is the change in the value of the investment, which I hope goes up and not down because I hate losing money! Let's start with the first, called return. Now the return is basically what your investment produces. I got 4 examples. Now think about 2 plots of land. Let's say 10 acres in Iowa and 10 acres in Death Valley, California. Now in Iowa, your investment in land will produce food. Yeah! And in Death Valley, your investment in land will produce tumbleweeds. Boo! Now buying fertile acres that produces something, in this case food, is better than land that produces nothing. So obviously it is better to buy the farmland in Iowa. But JeeMoney, I can't eat all that food. Of course not. You'll take the extra food that you don't eat and you go and sell it for money, which you can buy other things with. Now let's move on to the second example of a house. Now buying and living in a house gives you a return that is the same as if you had rented the same exact house somewhere else. So if you buy a $500,000 house, which would normally cost you $50,000 a year to rent, then your return is 10%. $50,000 divided by $500,000. Now let's talk about the example of a car. Everyone has always said, a car is not an investment. Well, actually, yes it is. And not just the 1963 Corvette. Woo, what a beauty. Now if buying a car saves you enough time and energy to devote to something else that can make you money, then that is the return on your investment. Well, how do you calculate that, JeeMoney? Well, I don't know. But what I do know is that you don't want to walk 30 miles a day. Now think about it. The actual value you get from a car is the same whether it's a $20,000 Camry or a $300,000 Ferrari. So the better investment is the cheaper car. Now let's talk about a business. Now business is something that makes products or provides services and tries to generate a profit. Now this profit is the return of the company. So let's say you have a $100,000 company and every year it profits $10,000. Well, the return of the company is 10%. $10,000 divided by $100,000. Now we'll go into more details in another video, but know this, most amateur investors never look at the return of a company. Many of the experts do, but most of the home gamers don't look at what the company actually produces. What? Why? Because they're speculators and not investors. Now if you follow JeeMoney's advice and you look at what the company is actually producing, then you will be ahead of most amateur investors. And you know what? It will pay off. So in the next video, we're going to talk about the second property of investing. See you then.